All right. A very good afternoon, everyone. Thank you so much for joining us once again to our tax webinar series, Tax Made Easy, with MBNA CPAs. So this is part of our business forum UAE activities, or you could consider as CSR activities that we do have, where we provide informative sessions and recorded sessions as well of our webinar series. So I think last time we had made some discussions already on calculating our tax liabilities, and last time our discussion was more into reconciliation of our income. So before we will be proceeding with the full discussion of the next topic, or the part two of our tax made easy calculating tax liabilities, we wanted to do first at least a recap of our previous discussion. So you will be seeing from your screen the questions that is related to the discussions that we have from the last webinar. Okay, so you could see from your screen the series of questions. It's actually 5 questions that we have made, just a recap of our previous discussion. So kindly answer these 5 questions, and I'll read that for you. Okay. I think we removed the 5th one. Okay, that was 4 questions. Sorry for that. We have 4 questions related to our previous discussion. So again, on the first question that we have related to our previous discussion, a recap of our tax made easy accounting income reconciliation. We had first question that is related to calculating, or the steps on calculating the taxable income as per UAE corporate tax. So we have what are the 2 steps related to calculating the taxable income as per UAE corporate tax. So is it determining the accounting income and apply relevant adjustments, or determining the gross revenue and deductible expenses, or we have the revenue minus deductible expenses, or taxable income minus adjustments? Okay, so which one is the correct answer? Okay, so for the first recap on the calculating taxable income, again, the question is calculating the taxable income. So we wanted first to identify what is the taxable income. So the first consideration, or the starting point of our calculation of our taxable income is determining your accounting income. That's the first approach. Second is applying the relevant adjustments for you to be able to get the taxable income. So the correct answer is the first one, determining the accounting, sorry for this, it's accounting income and apply relevant adjustment. So there's only 2 steps. Again, there's only 2 steps on calculating your taxable income. First, determine your accounting income. Second, apply the relevant adjustments. So from our last discussion, we have discussed this, that the first approach should be made for the accounting income. On the second question, so an example of exceptional circumstances and a reason to be permitted to use the cash basis accounting. Again, we have discussed from the last topic about the cash basis accounting. Would it be possible for the connected or the taxable person to maintain the cash basis accounting even if they have exceeded 3 million threshold? So the correct answer is yes. They could. This is considered as exceptional circumstances where they only made an exception for for only one tax period. So if it exceeds only for one tax period, they could still continue the cash basis accounting. But what if they have some accrual accounting, or they have adopted the cash basis accounting, and then they wanted to transfer to accrual accounting? In that case, that would be possible. They just need to reapply and do some adjustments or transitional adjustments for the conversion from cash basis to accrual accounting. But what if they have been doing the accrual accounting and then transferring back to cash basis accounting? In this case, this is not applicable. This might not be accepted by the FTA, but you could still try to apply for this one. This is subject for the approval of the FTA. Okay, so the correct answer is true. And then for the third question, which of the following is or which of the following requires to maintain audited financial statements? So the requirements for you to have the audited financial statements is if, for the FTA purposes, if you have exceeded the threshold of the revenue of 50 million. So if it is less than 50 million, there's no need for you to have the audited financial statements. But again, as per the commercial law of UAE, there is actually a requirement for you to have the audited financial statements. But that is as per the commercial law. But as per the FTA, you are only required to maintain audited financial statements once you exceed the revenue of 50 million. And please take note, not only for this one, for the exceeding revenue of 50 million, please take note that for companies under free zones, they also need to have an audited financial statements. Okay, so for the fourth recap, we have the which of the following is the starting point of the third determination of the taxable income for UAE corporate tax.
And what I did, I passed on JD. This JD I passed.
So the starting point of the determination of the taxable income for UAE corporate tax or the accounting income should be based on the accounting income, including the other comprehensive income. So in your comprehensive income statement, you will be able to see from there your what? Okay, so you will be able to see from there um your accounting income or your comprehensive income as the first basis for you to calculate for the taxable income. So that's the first one. Then after that, you will be applying the relevant adjustments. Then you will be needing to reflect those adjustments for you to be able to come up with the taxable income. Okay, so I think most of you have got the correct answer for the 4 questions, but you made some mistake for the calculation of the taxable income as per UE corporate tax, the 2 steps. So again, the two steps is first determining the accounting income, second, applying the relevant adjustments. So let's proceed now with our presentation on the calculating tax liability and identifying the relevant adjustments or applying the relevant adjustments. Okay. So what we will be talking about will be realization basis, the exempt income, and then the deductible expenses and non-deductible expenditures, and then calculating the tax liability. Okay. So again, in calculating our taxable income, the first or the 2 steps that we need to do is actually first determining the accounting income. Second is applying relevant adjustments for us to arrive with the taxable income. So just a question before we move with the presentation. Who amongst you here have done the filing for the corporate tax? Just use the emoticon or the react portion. Okay, you could use raise your hands if you have done the filing already. For those companies who have incorporated or has been incorporated since June, one with the year end or the fiscal year ending February 2020 or February. So who amongst you here have done the filing? Okay, I think no one. So please take note whenever you do the filing for the corporate tax, if the relief or the election that you have chosen for the filing of your corporate tax is under SBR or small business relief, you will not be required to provide any other information. So again, if you are going to apply for or going to elect the SBR or small business relief, there's no need to be for you to provide any other information. You just need to reflect how much was your revenue for the year and whether this revenue is applicable for you to apply for or to elect for small business relief. Once you apply for that certain option, then other informations on your filing will not be required. But please take note that if ever you go for small business relief, please consider as part of your decision factors would be if ever your company for that certain year have losses, then they could actually do some recovery. But if ever you don't have losses for the company and then you do have the revenue below 3 million and you apply for SPR, that's absolutely fine. But again, if ever you have some losses, it will be suggested for you to go and rather than going for SPR, you go for the normal filing. Okay. So there will be an option for you as well to do cash accounting or accrual accounting. Okay. So that's for the filing for SPR. Okay, so again, going back to this is the 2 steps in determining the taxable income. So what are I think we have done already the realization from last time, and we have identified that these are the relevant adjustments that we have to reflect. So the first adjustments that we have is really related to the election of whether we will be having the realization basis on recognition of your gains and losses. And then second is the exempt income. So there will be an adjustment on the exempt income. If it is exempt, it should be deducted from your accounting income. And then we have the understanding of the deductions. So whether it is deductible expenses or whether it is non-deductible expenses or expenses with limitations. And then we have some specific reliefs for specific transactions. We will be having this one discussed on the next webinar because it will be taking much time. And also related to transfer pricing adjustments, we will be having this one discussed as well, including the tax losses. So only portion probably in tax losses, but most of this discussions for this 3 would be discussed on our next webinar. So we still have some time to discuss this for you. So what we will be discussing as of today will be more into these 3. So unrealized gains or losses, exempt income, and then deductions. So at least we will be having a full understanding of the adjustments that we will be having for calculating our taxable income. Now, so normally, when you do the filing, there will be an option for you. Either you will be going to elect for realization basis, or you will just be continuing with your accounting income. So again, when you say realization or realization basis of your calculation for taxable income, it constitutes as if the realization of your recognition of either expenses or recognition of losses or your gains will be based of whether it has been sold or it has been disposed or it has been transferred or it has been settled. So what does we mean for this? So normally when you're applying for accrual basis of accounting, normally the process is you will be having a determination of the fair value of your assets. So for example, we have the investment properties. So normally for investment properties, they're held to I they will be held to go for maybe earning the rentals or appreciation of capital. So normally for this kind of assets, normally the recognition or the subsequent recognition for these assets is based on its fair value. So if ever the assets value or the assets fair value have increased, normally for this kind of assets, the increase of that certain fair value would be recognized as per the accounting standards, or on accrual basis. This certain increase of its fair value will be recognized. So normally you will be doing some adjustments on the probably your investment property. You will be doing some adjustments, increasing its value, and then the subsequent adjustment for it will be related to the increase or other income that is based on the increase of your or gains on the fair value adjustment of your investment property. So in that case, you will be having an income. So normally, in this case, if ever you go for realization basis, it will be adjusted. The reason being is, since this certain adjustment on your, or since this income recognition on your books was not really realized, meaning it has not been sold. So it does not become a cash or a transaction, basically. So in that case, this is still subject for realization. So again, going back, if ever you have a property of a building of, let's say, 30 million, and then the value of that certain building on the next year had increased to 35 million. So on your recognition for your accounting, as per the accounting standards, you will be needing to convert this certain building into its fair value, which is 35 million, and you will be having a gain of 5 million. So when you choose realization basis, this 5 million will be adjusted from your accounting income. So since it was added in your accounting income, it will be deducted. The reason being is it has not been realized yet. But once it will be realized, it will be added back. Okay? So that's the concept of unrealized gains and losses. So again, if it has been sold, it has been disposed, or it has been transferred and settled. Okay? Now, another example of the realized gains and losses, let's try to check with this example. So for example, if a company A's accounting income for the year ended December 31, 2024 has shown an amount of 7,900,000, and the company has included the fair value and impairment adjustments for the year of this much. So recognitions on the land's fair value of 1 million, and then recognize an impairment of inventory of 1,200,000. So the question is, how much would be your taxable income? So in this case, since the first, or well, let's try to use the two-step approach, okay? So the first determination is your accounting income. So your accounting income shows 7,900,000. So you will be needing to reflect it here as 7,900,000 as your accounting income for the year. Now, after that, you need to adjust. If ever you elect for realization basis, you need to adjust the gains on the land's fair value, since it has not been sold or transferred or settled or whatsoever. So since there is no transfer that has been made for this certain land, and it's only a book recognition for its fair value, so that should be adjusted on your accounting income, so that will be reduced. And then you will be needing to add back the impairment of your inventory. So normally for your inventory, it will be based on its net present value, whichever is lower, right? So in this case, if ever the carrying amount of the your inventory has lowered down, so normally you will be adjusting your inventory, and then you will be recognizing on a loss, or an expense related to the impairment of the inventory. So for this case, if ever you choose for realization basis, then you will be needing to adjust your impairment or your provision for slow moving inventory probably, or the impairment of your inventory. So you will be needing to adjust this back to your accounting income. So you will be needing to add it back. So in that case, in this certain example, we will be adding back the unrealized loss on inventory of 1,200,000, and then we will be coming up with our taxable income, or we will be able to come up with our taxable income of 8,100,000. So normally, for the calculation purposes, up to 375, that will be 0%. So you will not be paying taxes for this. And then above 9%, you will be needing to, or sorry, above 375. So 81 minus 375 times 9%, you will be able to come up with tax of 695,250, and up to corporate tax payable of 695,250. So this is based on a realized gains or losses. So if ever you elect for realization basis. So when you do the filing, there's also a subsequent questions related to realization basis. Okay, so you just need to fill in those information. So it's only a yes or no questions actually. So in this case, if ever you elect for realization basis, please take note that this might not be revocable. Meaning, if ever you choose for realization basis, it will be realization basis for the next period of filing as well. Because you cannot do the realization basis now, and then by next year you will be using, or you will not be using realization basis. So you have to be consistent. So once you choose realization basis now, it will be realization basis on the future. But if ever you wanted to change it from realization basis to the normal accounting recognition, so in this case, you will be needing to apply for the FTA for the approval. Okay, so please take note of that. So as part of decision making as well, whenever you go for either realization basis or not going for realization basis, so as part of decision factor, you have to consider whether there is sufficient or the normal impairments or increase of your fair value, or assets that is actually, or financial assets that is actually recognized at fair value, or is there any impairment in your inventory? So for example, with this one that we have, since the impairment of their inventory is much higher compared to the gains of their lands, so they have negative impact with them because they need to add back the impairment of the inventory of 1,200,000. But if it is less than that, then it would be better to go for realization basis. So it's up to you on doing the decision. Okay. So next, we'll have to discuss exempt income. So actually, for the corporate tax purposes, normally for the exempt income, as what we have done during our accounting income reconciliation, it will be based on our whether we have here the gross sales, that are gross taxable sales, and we have here on our accounting income with our sales, with our other incomes, and with our other comprehensive income. So normally, for the UAE corporate tax calculation, those incomes that actually are arising from the ownership interest, meaning we have an ownership to the other companies, normally for this case, this dividends or any profit distributions that we receive to this other company would not be taxed. So meaning it shouldn't be added as part of our taxable income. The reason being is, for these companies, this might have been already taxed, and if ever it will be taxed again from our end, then it will become a double taxation. So to avoid that, there will be an adjustment on our income when we receive some profit distribution from these companies. So it will not be included as part of our taxable income. So the three exempt incomes that we have is we have the domestic dividends, we have the participation income. So technically, this two is related to dividends. Okay. So for domestic dividends, automatically, all domestic dividends that we have received will be adjusted and will not be included as part of the taxable income. While on the participation income, we have to make sure that we have the ownership or we are a shareholder of the company with an ownership of at least 5% or more. So, and there's actually a subject on the conditions. One of the conditions is actually if ever you are keeping this certain share for more than 12 months. Because if your company is a holding company and you have been buying and selling, so that will become your activity. So in this case, if that is your activity, then that will be part of your taxable income. One of the requirements is for you to hold this certain asset for 12 months, minimum of 12 months. So if it has been held for minimum of 12 months, then the dividends that you have received or profit distributions that you have received for this certain income will not be or will be exempt for the calculation of your taxable income. Okay. So again, participation exemption for other incomes and gains. So it will be subject for certain conditions as well. Now, the third one is foreign permanent establishment exemption. So for foreign permanent establishment exemption, for example, if ever your company has been having some branches or some companies on other countries, and they have a permanent establishment in those countries as well. So normally what happens is on that certain country that they have been having the permanent establishment, they will be taxed from there. So to avoid this double taxation again, this this permanent establishment that has been taxed in that certain country shouldn't be included on the calculation of our taxable income here in the UAE. Because normally, for example, we have the branches there or subsidiary there on the other company. Normally, on our financial statements, we will be having the consolidated financial statements. So in that case, our consolidated financial statements will be adjusted with the revenues that we have with our permanent establishments. Okay, so that will be removed. And please take note that all expenses related to exempt income will be adjusted as well. So say for example, for our dividends, normally we will be having some processing of fees for legal or for documentation fees or for broker fees for buying the shares of stock. So normally this one shouldn't be part of the expenses of our on calculating our taxable income. So that should be adjusted. Normally for this kind of expenses, this would be considered as a capital expenditure supposedly on the accounting standards. So it should be part of the value of the shares that we have invested on the other companies. But again, if ever you have incurred this certain expenses, you have to remove this from your accounting income, or you need to do some adjustments on our accounting income with this. Okay, so again, all expenses related to exempt income should be adjusted and should be removed from the calculation of your taxable income. Okay, so these are the three. We have the domestic dividends, participation income, and then foreign permanent establishment exemption. So this is one of the adjustments we have for the revenue or income related. Okay. So the next discussion that we will be having would be the deductions. So for the deductions, normally, uh, the major the major consideration or the general rule is if your expenses are wholly and exclusively incurred for for the purpose of business, then yes, it will be deducted. So please take note if it is wholly and exclusively for the purpose of business. So it will be considered as deductible. Question: what if the expense is not wholly and exclusively um, uh, incurred for the purpose of business? For example, we have a travel expenses of the managing director. So part of their travel expenses, they have made some business meetings and all of those stuff, and then there is another sub or side transactions that has been done by the managing director where he was bringing the family as well for personal purposes. So in this case, if ever that certain personal purposes is not related to the business, meaning it is not part of the agreements that has been made for the managing director and all of those stuff, so that will be making the expenses for the travel as not wholly and exclusively used for the business. So in this case, the proportionate share of that certain expenses will be adjusted. So proportionate. So if it is not wholly, again, wholly and exclusively, if it is not wholly and exclusively, at least we will be able to identify which one is wholly and exclusively for the business. And then we will be needing to adjust whatever is used for the other types of expenses. Okay, so there are several types of expenses that we have. There is capital expenditures, there is revenue related expenditures. So normally for the calculation of your taxable income, the capital expenditures will not be deductible. The reason being is these capital expenditures are considered as part of your assets. So what are those capital expenditures? For example, you have done some leasehold improvements. Would the leasehold improvements be considered as leasehold expenses? In this case, if ever your leasehold improvements is for the benefit of the future capital in nature, so in this case, this leasehold improvement will be subject for depreciation. You will be needing to apply its expenses as part of your depreciation. But again, this will not be part wholly and exclusively, this will not be part of your expenses. So for capital expenditures, that could be considered as your asset and then depreciated after, but will not be considered as part of your expenditures. And then for revenue related expenditures, that will be considered as wholly and exclusively, so that will be deductible. Okay. What if the company has pre-operating expenses? Would that be considered as a capital expenditures because they are still doing the setting up of the business, or would that be considered as revenue expenditures? Normally, in accounting perspective, these pre-operating expenses would be expense outright. So would be expense outright. So in this case, this certain expenses, pre-operating expenses is part of your pre-operating and part of your revenue expenditures. So in this case, this will be deductible because this is for the purpose or wholly and exclusively for the business. So business operations. Okay. So pre-operating expenses, yes, deductible. But please take note, if ever your pre-operating expenses has been considered as part of asset and then amortized, then in that case, the amortized portion will be considered as deductible. Okay, so deductions not allowed. So what are those deductions that is not allowed for the UAE corporate taxable income calculation? So the deductions that is not allowed is actually the expenses that is not related to the business. So if it is not related to the business, remove it directly. So that should be adjusted. So for example, again, the example that we have is incurred expenditures for the travel, that is actually including the personal related expenses of the managing director. In this case, that will not be considered as part of your deductible expenses. So that should be added back in your accounting income or taxable income calculation. Now, the second one is the expenditures incurred in deriving exempt income. So, again, as what we have shown earlier as an example, for exempt income, if ever you incurred some expenses related to shares, buying the shares of stocks, brokers' fees, listing fees, or whatsoever that is related to buying of your shares for your exempt income, then that should not be considered as part of your deductible expenses. So that should be added back. Now, for losses that is not connected to or not connected with the taxable person's business, that should not be part of your deductible expenses. That should be considered as non-deductible expenses. Okay? So that should be adjusted as well. So for example, you have a personal losses on your shares. Let's say you have a personal investment and then you acquire some losses for that certain personal investments. Would you be allowed to deduct this in your business operations? The answer is no. You will not be allowed to deduct these losses that is arising outside of your business. Okay. And we have deductions with limitations. So we have the limitations on our entertainment expenditures that is having a limitation of 50%. So please consider this one as well on monitoring of your chart of accounts. So whenever you have the opportunity to review your chart of accounts, please make sure that you have the entertainment expenses separated for you to be able to have the portion of adjustments related to entertainment expenses. The reason being is entertainment expenses have a limitation of 50%. Okay, so next for interest expense. So for the interest expense, if ever your interest is more than 12 million, the limitation that we have from there is 30% of its EBITDA. So earnings before interest and taxes. So depreciation and amortization as well. So whenever you calculate for your accounting income, you will be having there the profit, and then you will be deducting your amortization and depreciation. So before that, before the interest as well, or if possible, you have your accounting income, you need to add back your interest expenses, you need to add back your depreciation and amortization for you to be able to get the EBITDA. So the portion of this EBITDA is 30%, whichever is greater. So in this case, that will be your limitation for deduction. Okay, so if it is more than 12 million, 30% of the EBITDA. But please take note that could be recovered in the next expenses that we have on the next taxable period. Okay, so that's for the deductions in terms of the calculation of your taxable income. Now, there is also what we call as non-deductible expenses. So what are those non-deductible expenses? So first, non-deductible expenses is your donations, grants, or gifts made to an entity that is not a qualifying public benefit entity. So the FTA has provided the list of qualifying public benefit entity. If ever you are providing donations, grants, or gifts other than this qualifying public benefit entity, that will not be considered as that will not be considered as deductible expenses. So that will be adjusted. So maybe one of the considerations as well for the accountants is to make sure you will be having a separate chart of accounts for donations, grants, and gifts. And you need to identify whether those donations are a qualifying public benefit entity. So those list is available in the list provided by the FDA. Okay. Fines and penalties. So these fines and penalties will not be considered as deductible expenses. So for example, you made late registration for corporate tax and you have a penalty of 10,000 penalty for late registration for corporate tax. Would that be considered as deductible expenses? The answer is no. So whenever you have your accounting income and you have there your fines and penalties, then that will be disregarded and that will be adjusted in your accounting income when you are arriving with your taxable income. Okay, so these fines and penalties will not be deductible expenses. That should be adjusted unless these fines and penalties are related to compensation of damages or breach of contract. So in this case, this amounts will be considered as deductible expenses. Say for example, you have made the contract of the maybe construction of your leasehold. So in this case, there was actually a breach of contract, and then you are needing to pay for the damages that you have incurred for the breach of the contract. So if that's the case, then yes, it could be a deductible expenses. Okay, and anti-bribery. So bribes or any illicit payments will not be deductible. So if ever you made some expenses under the table or whatsoever, this would not be considered as deductible expenses. So that should be adjusted as well. And then again, dividends, profit distributions, or benefits of a similar nature paid to the owner. So normally we have received some questions of the managing director or the owner is receiving salaries with the company. So would this salaries be considered as deductible expenses or not? The answer is it depends, because if ever the owner is or the company's formation is an LLC and the owner is actually considered as a connected person. So in that case, if the owner is considered as the connected person, the profile of the owner and then the service that has been provided by the owner will be based on the analysis or market analysis of that certain connected person, and then it might be deductible expenses. But if ever it is considered as dividends or profit distributions, normally that happens, then this certain expenses as profit distributions will be non-deductible expense. Okay, and fifth one is amounts withdrawn from business by a natural person who is taxable person under paragraph 11. So if ever, for example, a natural persons providing or having a share of the business income, but they are not considered as owner of the business. They are providing services. In this case, it will be considered as an incorporated partnership. So if ever you have made some withdrawals for the unincorporated partnership, then that shouldn't be considered as deductible expenses. So it's as if you are the owner as well, and that certain withdrawals or portion of your distributions will be considered, sorry, portion of your withdrawals will be considered as if you are doing the profit distributions, and in this case, that will not be deductible expenses. And then corporate tax. So corporate tax imposed on the taxable persons under the law is considered as non-deductible expenses. So your corporate tax is non-deductible expenses. You cannot deduct corporate tax and then calculate the corporate tax again. So that would not be considered as deductible expenses. And we have the input VAT, or the value added tax that could be recoverable, but you did not do some recovery of that certain input VAT. So if ever it is recoverable input VAT, then it should be recovered and it should not be part of your deductible expenses. Say, for example, you have incurred some expenses for maybe professional services, and then the VAT portion of it was recovered, and then you are adding it back as part of your expenses. So that shouldn't be done. That should be removed and considered as part of your input VAT recoverability and would not be added back again as part of your taxable or deductible expenses. So that should be adjusted. And if ever you have paid some taxes on the other countries, say for example, you have some projects outside of UAE, and then you have made some payments for taxes from there. So in this case, those taxes that you have paid for outside of the state will not be considered as deductible expenses. So again, that should be adjusted. But please take note of this. This might be considered as part of the foreign or permanent establishment consideration where it would not be considered as taxable income, so that would be an exempt income, and then any expenses related to it will be removed as well. And there's also an adjustment for your income that has been incurred outside of the UAE, which is having some double tax agreements that has been agreed with the UAE as well. So that could be adjusted. Okay. And then the other one is their expenditures as specified by the decision by the cabinet. So if there will be some adjustments or provision for the expenses or expenditures that is specified by the cabinet, would be non-deductible expenses. So they will be providing a list of which are those other expenditures that shouldn't be deducted. Okay, so that's for non-deductible expenses. So again, we already have discussed unrealized gains or losses, exempt income, and then the deductions. So for this three, we will be discussing this on the next webinar because this will be taking much time actually on the discussion. And for the calculation of your tax liability, so the normal calculation formula is this. Okay. So in calculating your tax liability, the first portion, again, there will be two steps only. We will be needing to establish or identify the accounting income. So if ever you are using accrual accounting, your accounting income will be shown here. And then you will be, if ever you elect for realization basis, that should be adjusted. So you will be needing to adjust here um, the realized gain and losses. But if ever you did not elect for the realization basis, so this will be disregarded. And then you will be needing to remove your exempt incomes, your dividends, and profit distributions, or any income related to foreign permanent establishments. So that will be removed as well, or that will be adjusted. Okay. And then this one is for free zones. So for the reliefs, and then for the other reliefs, that one we will be discussing on the next webinar session. So we will be discussing it into detail. And then our business restructuring reliefs as well. That will be discussed on the next webinar. So probably in our next webinar, we will be having a discussion for the qualifying group for free zones and then business restructuring reliefs as well. And then we will be needing to add back those non-deductible expenses. So the non-deductible expenses that we have was actually listed earlier. So we have expenditures not incurred wholly and exclusively for the business. So if ever we have portion of expenses that is not wholly and exclusively for the business, we will be needing to add it back. And then expenditures of capital in nature. Again, capital expenditures that is related to capital will be adjusted. And then portion of this allowed net interest expenditures to be carried forward for the next period. And then specific non-deductible interest expenses as well that will be adjusted. And then this allowed entertainment expenditures, so the 50% portion of your entertainment expenses will be adjusted as well. And then expenditures in relation to exempt income. So any expenses related to this exempt incomes shouldn't be part of your expenses. So that should be adjusted. And then other non-deductible expenditures. So question, we have a question actually. So what if our expenditures does not have the supporting documents? Would that be considered as deductible expenses? In general rule, if you're gonna see for corporate tax, it is actually a self-assessment filing. So it's up to you. But again, if ever there will be an audit that will be conducted, if you cannot provide the proof, then that will be considered as non-deductible expenses. So normally, so in this case, if ever you have a an expenses without any supporting documents, that might be considered as non-deductible expenditures, and that might be adjusted back. But again, it's a self-assessed filing, so it's up to you. If you will be taking that certain risk, you could actually do that. But whenever the audit will be conducted, you will be having some issues. Okay, and then we have an adjustment for related party transactions, not on the arm's length transaction. So this is actually a sample of a related party transactions. So again, this will be part of the special adjustments. So normally this one will be taking much time on the discussion. So we will be discussing this on the next session. Okay. And then we have the incentives. So special reliefs. So as of the moment, there is no special reliefs other than the SPR or the small business relief. So again, if you choose a small business relief, you will just be needing to report there your revenue and then alas. All other information will not be required. But again, SBR is only up to 2026. And then if there's any adjustments that will be specified by ministerial decisions, that will be adjusted here as well. So after this adjustments, you will be coming up or you will be having the value of your taxable income before tax loss relief. So if ever you have a tax losses, that could be carried forward. So this is one of the considerations actually whenever you choose small business relief. Okay, so if you have losses for this certain period and then for the next period you will be having an income, then much better not to avail a small business relief and do the filing. Because if ever you avail small business relief and then on the next period you will be needing to take that certain losses, that will not be possible. Okay, because it's as if you have disregarded the losses you have for the last period and it will not be carried forward. But if you wanted to carry forward the losses you have for the certain period of time, much better to go for a normal filing and do not go for a small business relief. Okay, this is one of the considerations. So again, for the for the tax losses, so tax loss relief, you'll be able to reflect it here for the adjustment. And then once you come up with the adjustment, you will be having your taxable income subject for corporate tax. And then you will be having a tax up to 375 of 0, and then above 375 of 9%. That will be the value. And then you will be needing to adjust, or you will be coming up with your corporate tax liability. And then we don't have withholding tax, so we will not be having this. And if ever we have a double tax agreement, as what we have discussed earlier, that will be adjusted as well here. So we will be able to come up with the corporate tax payable or refundable. Please take note please take note. Okay, corporate tax liability and corporate tax payable is different. Okay, corporate tax liability is based on your calculation of your taxable income subject for corporate tax. Your corporate tax payable will be affected by this certain adjustments. So it doesn't mean that if ever we have already come up with corporate tax liability, that will be your corporate tax payable. There might be some adjustments, and then from our corporate tax liability to come up with our corporate tax payable. Okay, so this is the calculation as well for your corporate tax relief. And that's it. Okay, so we are now open for the Q&A portion. We have 3 minutes to cater for the Q&A. So if ever you do have questions or clarifications, please raise your hand to answer those questions. Okay, any questions? Or else I'll be asking questions. No questions? Clarifications? So question, how does the filing for corporate tax looks like? So it's a lengthy process actually, but see, we have actually experienced a client where they don't want to go with a lengthy process because they are a small business, and for their business they don't have they don't reach the threshold of 3 million. And when we are looking at their profit, they are actually having a profit. So what we recommend to them is to go for SBR to avoid the other information. But again, it might not be recommended if ever please take note, if ever your first point is if ever your revenue is more than 3 million, so there's no need for you to go for SBR. But if it is less than that, then you go for SBR to avoid any complications. So there will be no questions asked. After choosing SBR, automatically you could submit your filing. But if ever there's also an option for cash and accrual. So if ever you choose for accrual, you need to itemize how much was your revenue that has been incurred, how much was the expenses related to the operations, how much was the expenses related to entertainment, to other to interest as well. So that will be itemized once you use the accrual basis, and then you will be able to come up with your accounting income. So that's how you do the filing. After that, then reflecting the adjustments. But when you go for cash basis, so there's no need for you to reflect your balance sheet items, only your profit and loss items or your other comprehensive income items as well. But if ever you choose for accrual basis of filing, you will be needing to reflect your balance sheet, some portion of your balance sheet items, and then the other comprehensive income. Okay, so that's for the filing. Any questions? None? Okay, so I think there's no questions and we are on time. So thank you so much for joining with us with our tax webinar series, and we have completed for the relevant adjustments. And for the other adjustments or special adjustments, we could consider as part of the special adjustments. We will be having this one discussed on the next webinar. So stay tuned with us on our webinar series with Tax Made Easy. Okay, thank you and have a good day.